85%. That's the probability markets are now pricing for a Fed rate cut on December 10th. Just 7 days ago, that number was 30%. In less than a week, the odds nearly tripled. Think about that for a second. On November 20th, CME FedWatch showed just 30% odds of a December cut, down from 98% a month earlier. Wall Street had given up on rate cuts. Then, on November 22nd, New York Fed President John Williams gave a speech saying he sees room for a further adjustment in the near term. Within 72 hours, the odds shot to 77%. By November 24th, they hit 85%. Markets exploded higher, the Nasdaq 100 jumped. The S&P 500 rallied. Bitcoin rebounded. Everyone celebrating cheap money coming back. But here's what they aren't telling you. This exact pattern happened before the 2008 collapse. September 2007, the Fed started cutting rates for the first time since 2003, dropping from 5.25% to 4.75%. Markets rallied. The Dow Jones hit an all-time high of 14,000 points. Everyone thought the Fed had saved the economy. 2 months later, the recession officially began. So here's the question, are we watching a replay? Is the Fed's December rate cut a rescue or a signal that something catastrophic is coming? Because the mechanism behind this 85% probability reveals a trap that could wipe out your portfolio before you even see it coming. Let's start with why the odds jumped so fast, because it wasn't economic strength. It was economic terror. On November 20th, the Bureau of Labor Statistics announced it would not release the October jobs report. The government shutdown, which lasted 43 days from early October to mid-November, prevented statisticians from gathering essential data. The October Consumer Price Index was also canceled. Survey-based data was simply not gathered. Translation: the Fed is making the most important monetary policy decision of the year completely blind. No jobs data. No inflation data. Nothing. Fed Chair Jerome Powell said it himself. Navigating the economy without standard datasets is like driving in the fog. You slow down. But here's the problem. The little data that is still trickling in shows the labor market is collapsing. The September jobs report, released with delays, showed the unemployment rate rising to 4.4%, the highest level since October 2021. Goldman Sachs research sees signs that the weakness in the U.S. job market is genuine. Transportation and warehousing lost 25,000 jobs. Fed Governor Christopher Waller said on November 24th that the job market was weak enough to warrant another quarter-point rate cut in December. San Francisco Fed President Mary Daly said the labor market is vulnerable. New York Fed President John Williams said downside risks to employment have increased. So the Fed is cutting rates in December, not because the economy is strong. They're cutting because it's weak. And when the Fed cuts rates into weakness, that's when crashes happen. But the chart I'm about to show you reveals why this is a trap, not a rescue. Here's the 2008 playbook, step by step. And we're following it exactly. Step 1. The Fed starts cutting rates. September 2007. The Fed lowered rates from 5.25% to 4.75%. The first cut since 2003. Markets cheered. The Dow hit 14,000, an all-time high. Everyone thought the Fed had prevented a recession. But the recession had already started. It officially began in December 2007, just 3 months after the first rate cut. The Fed didn't see it coming because the data was lagging. Sound familiar? Step 2. The Fed keeps cutting. By January 2008, the Fed slashed rates by 75 basis points in an emergency move, the largest drop in 25 years. They cut again in March by 75 basis points. Again in April by 25 basis points. The federal funds rate hit 2% by April 2008. Markets rallied every time the Fed cut rates. Traders thought more cheap money equals higher stock prices. But underneath, the credit markets were freezing. Banks were failing. The housing market was collapsing. Then in April 2008, the Fed paused. They said, the substantial easing of monetary policy to date, combined with ongoing measures to foster market liquidity, should help to promote moderate growth over time. They stopped cutting rates between April and October 2008 to assess the impact. That pause? That's when the global financial crisis exploded. Lehman Brothers collapsed in September 2008. The credit markets seized up. The Dow crashed from 14,000 to 6,500 by February 2009. Step 3. The Fed panics. October 2008. The Fed resumed cutting rates. 50 basis points in October, another 50 in November, 100 basis points in December, bringing rates to zero. But it was too late. The damage was done. The recession lasted until June 2009. Unemployment hit 10%. By October 2009, here's the brutal truth. When the Fed cuts rates aggressively, it's not a sign of strength. It's a signal that they see something catastrophic coming. And by the time markets realize it, it's too late. Now let's fast forward to today. November 2025, the Fed has already cut rates twice this year, bringing the federal funds rate down to a range of 3.75 to 4%. Markets are pricing in an 85% chance of another cut in December. Traders expect 2 more cuts in 2025 and at least 1 in 2026, bringing rates down to around 3%. But here's the trap: inflation is still at 3%, well above the Fed's 2% target. If the Fed cuts rates while inflation is elevated, they risk reigniting price increases. That's stagflation, slower growth plus higher inflation. The nightmare scenario where cash loses value and stocks crash. Swiss Re warned, stagflation risk is problematic for the Federal Reserve to address through monetary policy. Apollo forecasts inflation hovering around 3% by year-end. Jim Walker, chief economist at Alethea Capital, said cutting rates against this backdrop risks fueling stagflation, so the Fed is trapped. If they cut rates to support the weak labor market, they fuel inflation. If they don't cut rates, the economy crashes into recession. Either way, you lose. But here is the mechanism Wall Street doesn't want you to see. When the Fed cuts rates into weakness, it signals to institutional investors that the economy is in worse shape than official data shows. Smart money starts selling. Credit spreads widen. Liquidity dries up. And by the time retail investors realize what's happening, the crash is already underway. One of the Federal Reserve's preferred recession indicators has deteriorated as fast as it did in 2008. Spread between the yield on 3-month bills and the anticipated yield in a year and a half hit minus 113 basis points on April 4, 2025. The lowest level since last October and the largest single-day increase since late 2008 during the global financial crisis. JPMorgan raised the probability of a global recession to 60%, up from 40%, influenced by Trump's tariffs and policy uncertainty. Credit markets are showing stress. High-yield spreads are tightening, which historically precedes crashes. Banking shares globally experienced significant declines as fears of recession took hold. And the government data blackout means the Fed is making decisions blind. No October jobs report. No October CPI. The unemployment rate for October will never be known. The Fed is literally guessing. So here's the death spiral scenario. The Fed cuts rates on December 10th. Markets rally for a few days, maybe a few weeks. Everyone celebrates. Stocks hit new highs. But underneath, the economy is weakening. Corporate earnings disappoint. Layoffs accelerate. Credit defaults rise. By January or February 2026, the data finally catches up. The jobs reports show massive weakness. Inflation stays elevated. The Fed realizes they made a mistake. They either have to pause rate cuts, which crashes the market, or they keep cutting, which fuels stagflation. Either way, the trap closes. Stocks crash, bonds sell off. Credit markets freeze. It's 2008 all over again, except this time the Fed has less ammunition. They can't cut rates from 5.25% to 0 like they did in 2008. They're starting from 3.75%. They have maybe 150 basis points before they hit 0. Then what? Quantitative easing. Money printing, currency debasement. The dollar collapses. Gold explodes. Hard assets become the only safe haven. September 2007. Fed cuts rates, markets rally, recession begins. December 2007. Dow hits 14,000. February 2009. Dow crashes to 6,500. November 2025. Fed rate cut odds jump from 30% to 85% in 7 days. Labor market collapsing. Data blackout. Policy uncertainty at crisis levels. History doesn't repeat, but it rhymes. The 85% trap is set. The Fed's December rate cut isn't a rescue. It's a signal. And when central banks panic, markets crash. Are you watching the show, or are you positioned for the replay? What do you think? Drop your answer in the comments below.